It doesn't start with a crash. No alarms, no breaking news banner, no traders screaming on TV. It starts quietly, with a loan that lasts less than a day, 24 hours, and somehow that's enough to threaten the entire global financial system. Here's the uncomfortable truth most people don't realize. The world's biggest banks, governments, and corporations are not standing on long-term stability. They're standing on short-term trust, rolled over every single day. If that trust ever slips, even briefly, the damage wouldn't look like 2008. It would be faster, wider, and much harder to stop. And almost no one outside finance is paying attention. Right now, in the background of the global economy, trillions of dollars move through a market most people have never heard of. It doesn't show up on your bank app. It doesn't get dinner table debates. It barely makes headlines. But without it, modern finance doesn't function. This is the market that turns "I'll pay you tomorrow" into the foundation of global stability. And it's built almost entirely on confidence. Let's make this concrete. Imagine a bank that owns a huge pile of assets: government bonds, corporate debt, mortgage securities. On paper, it's wealthy. But here's the catch. Those assets are long-term. They mature in years, sometimes decades. The bank, meanwhile, has to operate daily. It has to settle trades, cover withdrawals, fund positions, meet obligations every single morning. So what does it do? It borrows. Not for years, not for months, overnight. This is where the 24-hour loan comes in. The deal is simple. One institution needs cash today, another has cash sitting idle. So they make a trade. I'll give you cash right now, you give me a high-quality asset as collateral. Tomorrow, we reverse the trade. You get your asset back, I get my cash back, plus a tiny bit of interest. That's it. That's the entire mechanism. It's called a repurchase agreement, a repo. Functionally, it's a pawn shop for the global financial system. And on most days, it works beautifully. Trillions of dollars change hands overnight. Rates barely move. No drama. Which is exactly why it's dangerous. Because the system only works if everyone agrees on one thing: that the collateral is safe, liquid, trustworthy. And that trust is not guaranteed. Here's why this matters right now. Over the last 2 decades, finance has become more complex, more leveraged, and more interconnected while relying more heavily on short-term funding. Banks fund long-term assets with overnight money. Hedge funds amplify returns using borrowed cash that must be renewed daily. Even governments lean on markets that assume smooth, continuous refinancing. It's a mismatch. Long promises, short patience. As long as nothing goes wrong, no one notices. But when something does go wrong, the clock starts ticking immediately. Because a 24-hour loan doesn't give you time to explain yourself. If lenders hesitate tomorrow morning, the money simply doesn't show up. And then the real math appears. Let's walk through how that turns into a problem. Suppose a major institution depends on rolling over hundreds of billions of dollars in overnight borrowing. Every morning those loans mature. Every morning they must be replaced. If lenders decide even temporarily that the collateral might be riskier than advertised, they demand higher interest or more collateral, or they walk away. That's not a moral judgment, it's risk management. But to the borrower, it's catastrophic. Because there is no backup plan for losing access to overnight funding at that scale. You can't sell long-term assets instantly without taking massive losses. You can't raise fresh capital overnight. You can't wait it out. You either get funded or you don't. This is where the system's quiet absurdity shows itself.
Institutions worth hundreds of billions of dollars can become insolvent in hours, not because their assets vanished, but because trust did. And here's the part most people miss. This doesn't require a bad economy. It doesn't require mass defaults. It doesn't require panic in the streets. It can start with something small. A spike in interest rates, a political shock, a surprise downgrade, a rumor that turns into hesitation. Once hesitation appears, the system amplifies it, because everyone knows everyone else is exposed, so no one wants to be last holding the collateral. This isn't theory, we've seen it happen. In 2008, the collapse wasn't caused by people waking up one morning and deciding banks were worthless. It was caused by overnight funding freezing. Repo markets seized up. Haircuts rose. Collateral was questioned. Institutions that looked fine on Friday were gone by Monday. And the response back then tells you everything you need to know about how serious this is. Central banks stepped in, not slowly, not cautiously, but aggressively. They became the lender of last resort for the overnight market, because without that intervention, the financial system would have simply stopped functioning. That wasn't a bailout driven by ideology, it was a plumbing emergency. Now here's the uncomfortable part. The system didn't become less dependent on short-term funding after 2008. In many ways, it became more dependent. Balance sheets grew, leverage shifted into less regulated corners, shadow banking expanded, and the belief set in that if things ever got bad, someone would step in again. That belief is stabilizing until it isn't, because it creates a strange dynamic. Risk doesn't disappear, it migrates into places that rely even more heavily on rolling short-term loans, into strategies that only work if funding remains cheap and continuous, into a world where tomorrow's liquidity is assumed, not earned. This is where hype and reality split. The hype says these are just technical markets, boring, mechanical. The reality is that they're emotional systems, dressed up as math. They price trust, and trust can reprice instantly. What makes the 24-hour loan uniquely dangerous isn't its size alone, it's its speed. There is no adjustment period, no slow unwind, no graceful exit. When confidence breaks, it snaps. And because so many institutions are linked through the same funding channels, stress doesn't stay isolated. It spreads laterally. A hedge fund pulls back, a bank tightens terms, a money market fund demands more collateral. Each move is rational. Together, they're destabilizing. This is why policymakers fear runs, not just on banks, but on markets. A run isn't about insolvency, it's about timing. Who needs cash now, and who's willing to wait? The irony is that the system is incredibly efficient. On normal days, it allocates capital smoothly, keeps rates low, greases the gears of global trade. But that efficiency comes at the cost of fragility. We've built a world where everything works until it doesn't, and the margin for error is measured in hours. Zoom out, and the implications get bigger. When overnight funding is the foundation, central banks become permanent backstops, whether they admit it or not. Markets price assets assuming emergency support exists. Institutions design strategies assuming liquidity will be there tomorrow. Governments run deficits assuming refinancing will always be possible. This isn't corruption, it's adaptation. But it means the system no longer tests itself the way textbooks suggest. Failure is delayed, stress is absorbed, signals are muted, until they're not. The 24-hour loan doesn't bankrupt the world by exploding. It bankrupts the world by revealing how thin the margin really is, that everything solid rests on daily renewal, that stability is borrowed, not owned. So here's the question worth sitting with. If the global economy depends on loans that reset every morning, and confidence is the only thing keeping them rolling, what happens the day confidence needs more than 24 hours?